Welcome back to the Canadian Money Podcast. Today's deep dive is into a really high-stakes economic environment. We're sitting here in January of 2026, and honestly, the signals driving the Canadian economy are, well, they're fundamentally contradictory.
They really are.
On one hand, you see the nation sort of struggling on the global trade front, but then you look at some of our most strategically positioned companies, and they are reporting just stunning, record-breaking corporate wins.
It's a real split-screen economy right now.
It is. So our mission today is to cut through this volatility. We've synthesized a massive stack of reports covering everything from major Canadian corporate earnings, and we are talking about Aritzia's massive push into the U.S.
Which is an incredible story.
It is. All the way to the precarious state of global trade policy, the ongoing saga of the Canadian dollar, and, the highly charged world of critical minerals. We aim to give you a concise but deep understanding of these conflicting signals, helping you figure out exactly which levers are moving the needle in 2026.
Great. Where should we start?
Let's set the table with a market snapshot from January 8th, 2026. Because on the surface, things look strong. The TSX Composite Index saw a really significant jump. It added 243.5 points to close at 32,378.64.
That's a strong day, no question.
It is a clear, positive indication of investor confidence in Canadian equities. But then you look at what was driving that movement, and it tells a more cautious story.
Okay.
Gold rose $24.30 U.S., trading at a staggering $4,486.80 U.S. per ounce.
Wow.
So this strong positive index movement, particularly when it's reinforced by massive increases in precious metals, it really reinforces a theme we've been tracking for months. The world and Canadian investors are still seeking safety and resource strength against a backdrop of, global uncertainty.
And that tension, growth on one hand and this fear of instability on the other, it's perfectly captured in the recent performance of the Canadian dollar.
The loonie.
The loonie. It just can't seem to catch a sustained break, even with that strong TSX day. On Thursday, the loonie dropped more than 0.2% against a persistently strengthening United States dollar.
Okay, so let's put some precision on that slide, because even small currency movements, they matter deeply to our purchasing power and our trade balance.
They absolutely do. The loonie closed at 72.12 cents U.S. So what does that mean practically?
Right.
It means $1 US now costs 1.386 Canadian dollars. This is a noticeable slide from the previous day's finish, where $1 US was 1.3823 Canadian dollars.
And if we zoom out to the beginning of the year, we're only a week in.
And we've already lost about 0.7% against the greenback. It just reflects this deep, persistent underlying weakness.
Now, whenever we talk about currency weakness, the natural counter-argument is always crude oil. Historically, our oil exports buoy the loonie. Did it provide enough relief this time?
It provided a critically important backstop, but it wasn't enough to reverse the trend. The loonie's decline was limited specifically because benchmark crude oil prices saw these sharp, significant upticks.
Okay.
This surge in oil was attributed to rising supply concerns, stemming from key geopolitical hotspots, Iran, Iraq, Russia, as well as some evolving U.S. policy regarding Venezuela's oil production.
So what were the numbers on that?
To put it into perspective, West Texas Intermediate, or WTI, which is the major North American crude benchmark, gained $2.55 U.S., closing at $58.65.4 a barrel.
Okay.
Meanwhile, Brent crude, the global benchmark, advanced $2.88, reaching $62.84. So yes, energy kept the currency from really plummeting, but the foundational economic trend is still a weakness in the face of U.S. dollar dominance.
And the reason that weakness persists seems to tie directly to our official trade numbers. The currency struggle feels like it reflects a fundamental shift we're seeing in our trade balance, a rapid move from surplus to deficit.
That's a great point.
Let's unpack those figures and what they imply about our exposure to global trade friction.
That's exactly right. The currency performance is really just a symptom of what's happening at our ports and our borders. Statistics Canada data for October revealed a major turning point. Canada flipped from a September trade surplus of 243 million Canadian dollars.
Okay, so we were in the black.
We were in the black. And then in October, we flipped to a trade deficit of 583 million Canadian dollars.
Wow.
This means, as a nation, we imported well over $500 million Canadian dollars more merchandise than we exported. And the underlying mechanics are what's worrying. Merchandise imports increased by a significant 3.4%, while exports only managed a sluggish 2.1% increase.
That surging import number is what concerns me most because it feels like direct evidence of global supply chains realigning around U.S. protectionism, and Canada is kind of caught in the middle.
That surging import data absolutely relates to the rise in U.S. trade friction. But first, let's look at the export side, because it shows how quickly we are losing ground south of the border.
Okay.
Exports to the U.S. made up 67.3% of all Canadian exports in that period. Now, while that percentage still sounds enormous, and
It's still 2/3 of our trade.
Exactly. But that 67.3% figure is actually the lowest amount recorded since the depths of the COVID-19 pandemic slowdown.
That's a huge tell.
It is. This decline suggests that the U.S.'s targeted duties and trade protection measures are now starting to deliver real economic pain to Canadian exporters.
And that pain is exacerbated by the import surge. You mentioned William Pellerin, the trade lawyer, who provided an extremely potent analogy. He said Canada is becoming a backdoor for the rest of the world to offload goods that the U.S. is blocking. This isn't just a theory, right? It's tangible in our data.
It's highly tangible, and it's a difficult position for Canadian manufacturers. Pellerin noted that we are seeing a rapid increase in imports of goods that historically would have gone straight into the much larger U.S. market.
Like what, for example?
He specifically cited examples like kitchen cabinets from Malaysian manufacturers and a broad array of Chinese manufactured goods. The analysis is simple. The global marketplace, facing high tariffs and trade friction when trying to enter the U.S. directly, sees Canada as an attractive, easier entry point for achieving better pricing.
So if I'm a Canadian business owner, I'm now facing a perfect storm. I have cheaper imported goods products the Americans didn't want because of their protectionist measures, flooding my domestic market, driving down my prices here.
Right.
And at the same time, if I try to export my own product, I face significant duties just to access my largest historical customer, the U.S. market.
That is precisely the difficult position Pellerin described.
Right.
Consider Canadian cabinet and wood makers. They are facing a punishing 25% tariff just to enter the U.S. market.
25%.
Which forces them to lose access or dramatically reduce profitability with their largest historical customer. And this isn't just about wood. The increase in general imports into Canada is happening because the entire rest of the world has effectively lost access to the U.S. market due to these same measures. This creates an immediate, painful dilemma for Canadian businesses.
This sounds like a crisis for any company that's captive to the U.S. market. And given that the Canadian government is pushing for aggressive trade diversification, what is the reality on the ground? Are businesses actually exploring new markets overseas?
Pellerin was quite blunt on this point. He said, no, not yet.
Not yet.
He believes the broad structural shift in exports away from the U.S. to other countries just isn't taking place. Instead of diversifying, he describes Canadian businesses as hunkering down.
Just trying to survive.
Yes. The primary focus right now is on survival before we can diversify exports, particularly for those companies that are heavily integrated into the U.S. supply chain. They need to absorb and manage the initial shock of losing U.S. clients before they can pivot and invest the time and capital required for diversification.
And if the tariffs on wood products only went into effect in October, we are likely to see even worse trade numbers in the coming months, right?
That is the widespread expectation. Pellerin pointed out that the data we just discussed only captures the initial impact of the tariffs.
It's a lagging indicator.
Exactly. Therefore, the November, December, and January data, when they're eventually released, are expected to show a further deeper erosion of sales and exports to the U.S. across a broad swath of sectors, not just wood.
And more imports coming in.
He also expects a commensurate rise in imported goods, which will further exacerbate the trade deficit numbers. The core message here is that diversification is a long-term goal, but surviving the immediate trade friction is the current priority for many Canadian exporters.
That economic pressure from the U.S. is the single biggest factor forcing Canada's hand on the diplomatic stage. And this brings us to the difficult, high-stakes tightrope walk we're undertaking, specifically regarding China.
That's right. If we are struggling to manage pain from the South, we have to aggressively seek opportunity elsewhere. And for a market of that size, China is, well, it's unavoidable.
The major news-driving policy right now is Prime Minister Mark Carney's upcoming visit to China to discuss trade and energy. And this isn't just a casual event, it's monumental.
It really is.
It marks the first meeting between a sitting Canadian Prime Minister and President Xi Jinping in over 8 years, outside of their brief formal encounter at the October APEC summit.
And the timing and context here are just crucial. Canada is pushing a highly ambitious, diversified trade strategy with the goal of doubling non-U.S. exports.
Bubbling.
This entire initiative is being driven almost exclusively by the continued and painful trade tensions with the U.S. Simply put, we need massive new buyers, and no other economy offers the sheer scale of China.
And it's important to acknowledge the intense political strain this relationship has endured. I mean, from the diplomatic incidents following the arrest of the Huawei executive in 2018 to the subsequent retaliatory arrests and accusations of election interference.
Right.
Yet, despite all of that, China remains an undeniable economic heavyweight for Canada.
Absolutely. China isn't just a major player. It is Canada's second largest trade partner. Bilateral merchandise trade totaled 118.7 billion Canadian dollars in 2024.
118 billion.
And on the resource side, China is the #1 buyer of crude oil shipped through Canada's critical Trans Mountain pipeline. That dependency is not easily dismissed.
Pedro Antunes, the economist, really drove home the necessity of this market. He noted that while the U.S. is 26% of the global economy, China represents a colossal 17%.
Too big to ignore.
Exactly, especially for Canadian resource and agricultural products. He also suggested that Carney is intentionally adopting a softer tone, focusing on the economics of things and slacking a little bit on the strong stance that we've had against Beijing just to facilitate progress on trade.
But this relationship, it isn't a straightforward negotiation. It's currently defined by an ongoing, damaging tariff battle, a true tit-for-tat exchange of trade weapons.
Okay, let's detail those specific trade weapons. On Canada's side, we initiated the action against vehicles, imposing a massive 100% duty on Chinese electric vehicles in 2024. What was the core motivation behind such a drastic levy?
That was a highly strategic defensive measure. It was done explicitly to protect the Canadian auto industry from a sudden, subsidized influx of highly competitive Chinese EVs, which threatened to overwhelm North American manufacturers.
So we were protecting our own turf.
We felt compelled to mirror the protectionist actions taken by our neighbors to the south.
And China's retaliation was swift and targeted a crucial Canadian export.
It was immediate and painful. China responded by imposing significant duties on one of Canada's most important agricultural products. A 100% levy on canola oil, and a 76% duty on canola seed imports.
Ouch.
The Canola Council of Canada, which speaks for a massive segment of our agriculture sector, stating clearly that resolving these retaliatory tariffs requires a high-level political solution. That's why Carney's trip is so critical. They are desperate to reopen the Chinese market for smoother, more predictable canola trade.
And the trade friction extends beyond just vehicles and crops.
It does. Last year, Canada also imposed a 25% surtax on products containing Chinese steel and reduced the level of tariff-free steel imports allowed.
And what was China's response to that?
China saw this as an unfair restriction on their goods and promptly filed a challenge at the World Trade Organization, elevating the dispute to the highest international legal forum. This just shows the deep complexity and, frankly, the legal quagmire that defines the current bilateral relationship.
So it's clear Canada is trying to lessen its reliance on the U.S. through this diplomatic China push. But Antunes' ultimate analysis stresses that Canada will remain very dependent on the U.S. and that we require the continuation and successful renegotiation of the CUSMA, a trade deal, which, for those unfamiliar, is the foundational trade deal governing North America.
This is the absolute crux of the policy dilemma. The China strategy is not about replacement. It's about what Antunes termed pain management.
Pain management. I like that.
The goal is simply to lessen the pain that we're currently feeling by expanding our trade to the rest of the world. Our reliance on the U.S. market and the CUSMA framework, the Canada-United States-Mexico Agreement, is fundamentally non-negotiable for Canadian economic stability.
And compounding that CUSMA challenge are the escalating concerns from American industries. They're worried that Canada and Mexico are exploiting the preferential trade access afforded by CUSMA. What's the specific fear there?
The fear is that we are creating a backdoor for Asian goods. American industries worry that Canadian and Mexican firms are importing heavy volumes of components, particularly from China, incorporating them minimally, and then exporting the finished products back into the U.S. under the guise of CUSMA preference, essentially bypassing those tough U.S. protectionist tariffs.
So that issue of rules of origin and Chinese content is going to be a huge deal as the CUSMA review
It
approaches.
will loom large and create immense pressure.
So on one hand, we have the Canadian government wrestling with these existential trade dilemmas, tariffs, it's a currency under pressure. But on the other hand, certain Canadian corporations seem to be not just surviving, but absolutely thriving.
Yes.
And they're using the very market that is causing us so much pain, the U.S., as their primary engine for explosive growth. It's a remarkable contradiction.
It is the defining contradiction of the current moment. This robust corporate success is happening because these companies are either in sectors exempt from the trade protection measures, or they are benefiting immensely from the weak Canadian dollar, which makes their operations and products cheaper for American consumers.
Okay, so let's start with the tech outlook for 2026. This is based on an insightful analysis from RBC.
Right. RBC forecasts broader gains for Canadian tech stocks this year. The rationale is stabilizing software valuations and, critically, expectations for dramatically improved earnings growth across the board.
Okay, so to understand this potential acceleration, we have to look back at 2025.
We do. In 2025, the S&P/TSX Infotech subsector actually lagged the broader S&P/TSX Composite Index. The composite gained 28%, but Infotech only rose 23%.
And that lag was driven by genuine fear, wasn't it? The fear that artificial intelligence was coming to completely disrupt and destroy established software business models, leading to a massive reassessment of valuations. Was that fear overblown?
Analyst Paul Schreiber from RBC Dominion Securities argues those fears are indeed beginning to wane and were likely overdone in 2025. Last year, only about half of the tech stocks RBC tracked posted gains.
Only half.
Primarily because investors were concerned that AI tools would significantly boost developer productivity to the point where end customers, large corporations, could just develop their own internal software solutions in-house, eliminating the need for traditional vendors.
That makes sense in theory. If I can automate software development, I don't need a license from a vendor. But the shift from theory to widespread enterprise application is rarely instant.
Exactly. Schreiber's detailed argument against immediate radical disruption is rooted firmly in business practicality and organizational inertia.
Okay.
Enterprise software companies that are least at risk are those whose products require constant integration of customer feedback and deeply customized workflows. Even with better developer productivity from AI tools, any new entrants or companies trying to develop their own mission-critical systems would still face immense regulatory hurdles.
Right, you can't just flip a switch.
You can't. You need to rigorously test and evaluate all workflows and use cases before deploying any AI-generated software solution. This internal friction, along with the complexity of data integration, it limits that radical disruption in the near term.
So the immediate impact of AI isn't destruction, it's forcing corporations to spend money preparing for it. It's an accelerator, not a destroyer.
Precisely. The most significant upside for tech spending comes from what RBC terms AI readiness. The use cases that generate real productivity gains and revenue growth will likely drive massively increased tech spending across the corporate landscape.
And what does that spending look like?
It includes mandatory legacy system upgrades, which are often necessary to handle new AI data flows, the crucial elimination of disparate data silos, and the automation of manual repetitive business processes.
And what does this acceleration translate into for Canadian tech growth targets this year?
RBC is forecasting serious acceleration. Across their covered stocks, the median is expected to post 12% year-over-year revenue growth and a strong 19% growth in adjusted EBITDA.
And EBITDA is that key metric for underlying profitability.
It is, and the key leader in this anticipated acceleration remains Shopify, one of Canada's crown tech jewels. RBC has set a $200 U.S. price target for Shopify, suggesting a potential 27% return over the next 12 months. That's very bullish.
That's a powerful story in tech. Now let's pivot to retail, where Aritzia seems to be operating in an alternate, highly successful universe, reporting staggering growth numbers that defy the national economic gloom.
Aritzia is the textbook example of a Canadian company executing a growth strategy that successfully isolates it from the trade friction facing our commodity exporters. The Vancouver-based women's apparel retailer reported record net revenue of 1.04 billion Canadian dollars in the third quarter of its 2026 fiscal year.
$1 billion Canadian dollars in revenue in a single quarter is an unbelievable metric for a Canadian retailer.
It is, and that number represents 43% growth year over year. The CEO, Jennifer Wong, attributed this success to excellent operational execution across our three strategic growth levers: geographic expansion, digital growth, and increased brand awareness. But the story is really about geography and currency.
Let's focus on that geographic expansion because, in a supreme irony, Aritzia is succeeding by absolutely dominating the very market that is imposing tariffs on our wood and steel, the United States.
The U.S. is not just an engine of growth, it is the majority shareholder in their success. U.S. net revenue grew an incredible 54% year-over-year to 621 million Canadian dollars.
54%.
This means Aritzia's American business now makes up just under 60% of its total net revenue.
So they're essentially a U.S.-driven retailer that happens to be headquartered in Vancouver. And the success, as you alluded to, has to be partially currency-driven, right?
Right, absolutely. When the loonie is weak, as we discussed earlier, trading at just 72 cents U.S., it provides a massive structural advantage to Canadian retailers who earn revenue in U.S. dollars while keeping core operating costs, like headquarters stats and Canadian leases, in weaker Canadian dollars.
It's a huge tailwind.
It is. This currency tailwind boosts their profit margins and allows them to compete very aggressively on price in the U.S. market, unlike, say, a lumber company whose product is hit with a protectionist duty.
And their sales channels are strong across the board, not just in brick-and-mortar stores.
That's right. Retail net revenue, which includes new and repositioned boutiques, plus double-digit comparable sales growth in both Canada and the U.S., rose 35% to 657.3 million Canadian dollars.
And e-commerce.
E-commerce revenue increased by 58% to 383 million Canadian dollars, making up almost 37% of total net revenue, significantly aided by the launch of a new mobile app. This is truly a textbook case of leveraging international expansion and digital channels simultaneously to achieve massive, decoupled growth.
Okay, let's just unpack this for a moment. We've talked about Canadian companies finding these incredible ways to grow through international expansion, whether it's software like Shopify or consumer retail apparel like Aritzia. But growth also requires sustained performance, resilience, and attention to the complexities of global supply chains and shifting climates.
That's a great point. It's not just about one good quarter.
Right. And that focus on long-term performance and natural resilience is why we are so proud to partner with Hypernatural Style. Hypernatural is redefining clean bioperformance clothing. They focus on reducing impact on the planet, offering tees, polos, and button-ups that deliver unmatched comfort, performance, and smart style, all while working with nature and not against it. It's truly made better by nature.
That sounds interesting.
Hypernatural's garments feature patented hypercool jade technology for a uniquely cool-to-the-touch feel, naturally lowering your body temperature by 3 to 5 degrees for a guaranteed cooling effect when the temperature rises. They combine the world's softest, most durable Supima cotton with jade sheet and viscose, which is derived from natural crab shells, providing breathable, odor-resistant performance without the harmful synthetics you find in traditional performance fabrics.
So it's performance wear, but natural.
Exactly. And as a loyal listener of the Canadian Money podcast, you can experience this for yourself and get 20% off your entire order and use code TCMP at checkout.
Okay, so shifting from consumer resilience to long-term national resilience, we have to look at the foundational elements of Canada's future wealth, its resources, specifically critical minerals. The investment thesis in this sector is arguably the most compelling and strategically important story right now.
I agree.
Global X analyst Brooke Thackeray identified 4 major minerals expected to lead the way in 2026, all driven by a shared, powerful economic reality.
Then what's that?
Demand is accelerating much faster than global supply can keep pace. These 4 are silver, gold, uranium, and copper.
Okay, we've seen gold's price soar, which speaks to global risk, but why is silver, which is often overshadowed, standing out so strongly from a structural perspective right now?
Silver is structurally fascinating because it faces a growing supply deficit. While gold is mainly a monetary metal, silver is highly industrial.
Right, for manufacturing.
Yes, exactly. Beyond its traditional uses, there is a rapidly growing need for silver in photovoltaics, specifically solar panels, and other clean energy technologies required for the global energy transition. This industrial application, tied to massive long-term government green energy mandates, is creating a demand floor that conventional monetary demand alone cannot match.
What about gold? We noted its staggering price in the market snapshot. Who is driving that continued upward movement, and is North American investment finally catching up?
Gold is expected to remain robustly supported, primarily by continued central bank buying globally. This is driven by geopolitical risk and a desire for assets outside the traditional fiat currency system.
Okay.
What is genuinely interesting for the North American investor is that historically, interest here has been relatively low, even when gold reached these near all-time price highs. This was clear in the decrease of ounces held by the major U.S. gold ETF since its 2020 peak.
So we weren't buying in.
But over the last couple of months, we are seeing a reversal of that trend. North American investors are finally starting to climb back in, indicating that the risk-off sentiment is becoming more widespread domestically.
And uranium, which is often forgotten, is seeing a renaissance driven by clear governmental policy.
Exactly. Uranium is key due to rapidly rising global electricity demand and a renewed, profound interest in nuclear power as a clean, reliable, baseload energy source.
And this isn't just speculative.
No, it's being fueled by direct action. A major catalyst was the 304 million Canadian dollars federal loan provided to AtkinsRéalis for the development of the next generation of CANDU reactor technology. This commitment provides a clear, long-term demand signal for Canadian uranium producers.
Finally, copper, the industrial metal that often acts as the bellwether for the entire global economy. What are the key drivers propelling copper right now?
Copper continues to benefit immensely from global electrification and, crucially, long-term supply constraints due to years of underinvestment in mining exploration and development. However, it is the most sensitive of the four minerals to the global economy.
How so?
Thackeray warns that if China or the global economy experience a severe slowdown, copper prices could be the first to pull back, highlighting its fundamental connection to global industrial health.
That strong demand for industrial metals ties into the macro investment strategy we saw from Stan Wong, who singled out the Invesco DB Base Metals ETF, ticker DBB, as a top pick. Why go for a diversified basket of industrial metals instead of just copper or gold?
Wong's view is rooted in cyclical trends and structural support. The Invesco DB Base Metals ETF provides diversified exposure to industrial metals like copper, aluminum, and zinc. He noted that near-term technical conditions are highly supportive.
What does that mean?
It means copper has recently reached new all-time highs, while both aluminum and zinc have broken out to new 52-week highs. When you see all three moving in lockstep like that, it signals broad industrial strength.
And this movement follows a classic historical pattern, doesn't it?
Historically, yes. Base metals often begin to strongly outperform after precious metals surge. The surge in gold signals uncertainty, but the acceleration of base metals signals that economic activity and infrastructure spending are truly starting to accelerate.
Right.
Wong also points to long-term structural tailwinds that underpin this. Global electrification, massive renewable energy deployment, ubiquitous electric vehicle adoption, and global infrastructure renewal, all against a backdrop of tightening supply due to years of underinvestment in mine capacity.
But there's a new explosive demand driver tied directly back to the technology sector we discussed earlier, the build-out of AI infrastructure.
That is the most compelling new factor and a massive unforeseen demand shock. The explosive build-out of AI-driven data centers and the associated need for enhanced power grid infrastructure is accelerating demand dramatically for copper-intensive equipment.
What kind of equipment?
We're talking about massive demand for transformers, cabling, and switching gear just to power the incredible energy appetite of AI computing. When you combine this new source of demand with existing tight stimulus, all signals point to sustained, high physical consumption of industrial metals.
This emphasis on specific high-demand, market-driven metals brings us to the broader and often heavily criticized Canadian critical minerals strategy. Natural Resources Canada lists 34 minerals as critical, but the government is prioritizing only 6 for major investment.
This is where strategic vision meets resource reality. Natural Resources Canada defines 34 minerals as critical for economic security and clean energy, covering an enormous spectrum.
And the government is focusing on which 6?
They're strategically prioritizing 6 key minerals for investment and policy support: lithium, graphite, nickel, cobalt, copper, and rare earth elements. The government frames this strategy as a generational opportunity to reduce reliance on foreign, often adversarial suppliers.
But if we're going to put our national capital behind this, we need to ensure we have a competitive edge. And there is a substantial critique arguing that Canada might be chasing minerals where it doesn't actually have a global competitive advantage.
That highly influential critique comes from Jack M. Mintz of the C.D. Howe Institute. Mintz argues that Canada should be focusing its limited policy resources and investment capital on minerals, where it has demonstrated large reserves and production capability.
So play to our strengths.
Exactly. He lists nickel, zinc, uranium, potash, iron, gold, and copper as the clear winners for a national strategy. He believes the government's strategy is currently too focused on niche or early-stage resources.
And lithium, which is high on the government's critical list, is the perfect example of this potential policy mismatch. Why is Mintz so skeptical about lithium?
His skepticism is based on global geology and competitive reality. Mintz suggests that the focus on lithium is fundamentally misplaced because the largest estimated global resources of lithium are concentrated in South America, specifically the Lithium Triangle spanning Bolivia, Chile, and Argentina.
Okay.
He argues rhetorically that that's where people are looking for lithium. They're not going to be looking at Canada for lithium. He suggests that some of these niche critical minerals are simply too early stage, lacking a big enough market, or requiring massive infrastructure investment for Canada to compete effectively on a global scale right now.
That makes the policy decision complex. Is it better to focus on what we are already excellent at, like nickel and uranium, or bet on the future strategic need for minerals like lithium, even if we are not resource-rich?
It's the classic strategic debate. Mintz favors focusing on existing strength for immediate economic returns. However, the earlier example of uranium shows that government intervention can, in fact, create a market.
Right, with the CanDU loan.
Exactly. Brooke Thackeray agreed with the sentiment that the big catalyst for these niche minerals will be when governments get heavily involved. That government commitment signals stability and potential long-term contracts, which can turn a promising resource that lacks immediate global dominance into a viable strategic market over time. But it requires that significant early capital and policy commitment.
Before we move on to local issues, we have to recognize one more major corporate success story that perfectly illustrates how Canadian ingenuity can find a lucrative, stable niche in the U.S. market, even amidst trade tensions. MDA Space.
This is an immense win for Canada's advanced manufacturing and defense industry, completely divorced from the commodity pain we discussed earlier. Shares of MDA Space, the Brampton, Ontario-based satellite and communications firm, rose as much as 8.5% following their announcement of a new contract with the U.S. Missile Defense Agency.
Okay, so what's the strategic scale of this U.S. program, the SHIELD initiative?
The contract is a fixed date and quantity deal for America's SHIELD program. That stands for Scalable Homeland Innovative Enterprise Layered Defense. This program is huge. It was launched in 2025 as a $1.15 billion US contracting vehicle designed to modernize U.S. missile defenses through layered satellites and sensors.
And the immediate contract, while a win, is truly a strategic gateway for the company into much larger long-term revenue streams.
Absolutely. The company confirmed that this contract positions MDA Space to bid on future tasks and services that support the broader initiative. Amy McLeod, MDA's Vice President of Corporate Communications, confirmed that this opens the door to bidding on tasks within the truly staggering $151 billion US total SHIELD procurement vehicle.
$151 billion.
It demonstrates that for specialized high-tech Canadian firms, the U.S. remains an indispensable customer and partner, capable of generating massive, sustained future revenue opportunities.
So we've painted a picture of national trade woes offset by robust corporate and resource sector potential. Now we need to bring it right home, literally, to see how these macroeconomic pressures are filtering down into local affordability and the high cost of living, starting with the City of Toronto's 2026 operating budget.
Right. The Toronto budget reflects the direct financial strain families are feeling from inflation and the generally high cost of living. Mayor Olivia Chow and the City Council proposed an $18.9 billion Canadian dollars operating budget, with several measures explicitly aimed at making life more affordable for Toronto families.
The headline figure for homeowners is always the property tax hike. After 2 years of massive increases, what are Torontonians facing this year?
After a 9.5% hike in 2024 and a 6.9% hike last year, the proposed budget includes a much more restrained 2.2% property tax hike.
So much lower.
Much lower. And while it's still an increase, the city is positioning it as significantly more manageable compared to the previous 2 years.
What does that 2.2% translate to in actual dollars for the average resident?
For the average Toronto home, which is currently assessed at $692,140 Canadian dollars, this 2.2% hike translates to an additional cost of about $91.53 a year.
So under $100.
Right. The city is keen to stress that this is a relatively modest increase compared to what other municipalities in the Greater Toronto Area are contemplating.
Beyond property taxes, what concrete affordability measures are included to help cushion that financial squeeze, particularly for transit users and families?
A critical measure for daily commuters is a freeze on Toronto Transit Commission, or TTC, fares for the third straight year.
That's big.
It is. And beyond the fare freeze, the budget proposes a fare cap at 47 rides per calendar month this year, which is set to drop to 40 rides in 2027. This directly limits the maximum monthly spending for the most frequent transit riders.
And other social supports.
The budget also allocates funds toward vital social supports, including providing more free meals for students, keeping libraries open 7 days a week to act as community hubs, and funding the hiring of hundreds of new police officers and paramedics under a multi-year safety plan.
So Toronto is attempting to thread the needle. A relatively modest tax increase combined with targeted social spending and transit relief. Now let's shift focus across the country to Vancouver, which presents a completely unique, almost unbelievable housing paradox.
It really is something else. Vancouver's real estate market has been defined for a decade by high demand, soaring prices, and a chronic housing crisis. The conventional belief has always been that there simply wasn't enough supply.
Right, build more houses.
But the newest data shows a major disconnect. Despite efforts to increase housing stock, the market is suddenly stalling in a profound way.
How bad were sales in 2025, and what does this signal?
Greater Vancouver Realtors reported that 2025 recorded the lowest annual home sales total in the region in more than 2 decades.
2 decades. Wow.
Sales were down 10.4% from 2024 and were nearly 25% below the 10-year annual average. This isn't a small dip. It's a dramatic deceleration that has been building for 3 years, driven by high interest rates and the simple inability of buyers to afford the prices.
But the conventional wisdom, fueled by governments across the province, was always to build more, and that the housing crisis was purely a supply problem. We've seen major pushes to increase supply, including the elimination of single-family zoning across most of the province. If supply is up, why are sales stagnant?
That is the core of the paradox. Despite more housing units coming online, with condo towers continuously rising, the sales volume is stagnant. The Canada Mortgage and Housing Corporation, CMHC, reported over 2,500 new condos were sitting empty and unsold in Metro Vancouver as of October.
2,500 empty units.
No. Greg Zalotti, president of Rennie, a real estate marketing firm, noted that the last time they saw this level of developer-owned, unsold inventory was 24 years ago. This suggests that the problem isn't just about the number of units. It's about the type and price of the units being built.
So inventory is high, sales are low, and prices are even starting to fall year over year. Why aren't buyers jumping in to seize these opportunities?
Because while prices are falling, they are still nowhere near enough to bridge the massive affordability gap, especially with high interest rates punishing mortgage holders.
Can you give us the benchmarks?
Sure. Let's look at the December benchmarks to illustrate the scale of the problem. The benchmark price for a detached home was $1,879,800 Canadian dollars, down 5.3% year over year.
Okay.
The benchmark for a condo was $710,000, also down 5.3%. And townhouses averaged over $1 million. A 5.3% drop-off, a million-plus benchmark price, is simply not enough to move the needle for the majority of first-time buyers.
And there's a dramatic shift in buyer behavior. Buyers are no longer willing to rush into the smallest possible unit just to get a foot in the door. The panic seems to have subsided.
The urgency is definitely gone. Would-be buyers are now taking a pass. They are unwilling to fork over more than 700,000 Canadian dollars for small 450-square-foot condos. They're looking for quality of life now.
They want more space.
They want something much larger, up to 1,500 square feet, if they're going to spend north of $800,000 for a place to live. Buyers are now discerning, waiting for a true price correction or for rates to fall.
But this introduces a structural dilemma for the developers who are sitting on this unsold inventory. If development costs are too high, they can't afford to lower prices to meet buyer resistance without going bankrupt.
That is the painful structural issue highlighted by Anne McMullen of the Urban Development Institute. She explained that development costs, including construction materials and labor, have escalated so much that currently Building a new unit is simply out of the price range of 80% of the public in Metro Vancouver.
80%.
Developers must charge those high benchmark prices to recoup the exorbitant amounts they paid for land acquisition years ago. The market is waiting for prices to normalize toward income realities, but the construction economics and historical land costs make that structural correction extremely difficult, leading to this prolonged period of stagnation.
So as we synthesize all these findings, the so what for you, the learner and investor, is that the Canadian economy in early 2026 is defined by these extreme, almost absurd contrasts. We are seeing robust, internationally focused corporate success, Aritzia's massive U.S. growth, MDA Space's massive U.S. defense contracts, juxtaposed against severe domestic market struggles.
And those struggles are evident in the persistently weak loonie, the rapid and painful flip to a trade deficit driven by rising global imports, and the freezing of real estate sales in major markets like Vancouver.
The pursuit of trade diversification away from the U.S. is essential for future stability, but it is currently marked by painful targeted duties and a very sensitive diplomatic tightrope walk between Washington and Beijing.
The future investment narrative is clearly focused on resilience and resource demand. In the technology sector, we anticipate revenue and EBITDA acceleration as the immediate fears of radical AI disruption fade due to implementation friction. Meanwhile, in the resource sector, market focus is tight on major minerals with structural deficits. Gold, silver, uranium, and copper, all benefiting from either geopolitical risk or the accelerating demand from electrification and AI data centers. This focus is happening even as experts critique the government's broader critical minerals strategy for perhaps prioritizing niche minerals like lithium, where Canada lacks immediate global reserve dominance.
Okay, let's quickly review the core metrics that define this complicated moment.
Let's do it.
The trade deficit flipped to 583 million Canadian dollars in October, driven by surging imports that are rerouting global supply chains through Canada and reduced U.S. exports, which fell to a post-pandemic low of 67% of total exports.
Retail strength remains powerful and currency boosted, with Aritzia's Q3 revenue topping 1.04 billion Canadian dollars, powered by a 54% year-over-year growth in the U.S. market, which now accounts for nearly 60% of its net revenue.
Tech bets are strong, with RBC expecting median-covered Canadian tech stocks to post 12% revenue growth, led by Shopify, as fears about AI disrupting traditional software business models dissipate.
And finally, the real estate warning in Vancouver. 2025 saw the lowest home sales in 2 decades, despite falling prices. The high benchmarks and buyer resistance to purchasing small, expensive units means over 2,500 new condos are now sitting unsold, exposing the structural dilemma developers face with high land costs.
The report suggests that Canada's economic health relies heavily on successful non-U.S. diversification and aggressively leveraging its immense resource wealth. But if the global economy slows, which of these two major drivers, the tactical, market-based success of a consumer-focused company like Aritzia thriving in the competitive U.S. market thanks to a weak loonie, or the long-term strategic investment in foundational critical minerals like copper that power the global infrastructure revolution, which will prove to be the real stabilizing engine for Canadian economic growth in 2026? What stands out to you as the greatest risk or opportunity moving forward?